Welcome to SmithWeekly Discussions, an occasional program for our readers and listeners of SmithWeekly Research. Please note this program is a private discussion and everything contained is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine the show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at SmithWeekly, including Neil R., Anhill O., Casper J., and Sean W. Dave Cates has returned to the show. Dave is president and CEO of Denison Mines, a Canadian-focused uranium project developer advancing the Wheeler River project. Denison also owns a 22.5% stake in McLean Lake Mill. The company is listed on the New York Stock Exchange under the symbol DNN and also on the Toronto Stock Exchange under the symbol DML. Dave, how you doing, sir?
Andrew, I'm doing well. Thanks for having me back on.
Well, Dave, let's get your thoughts here on the market and what do you expect to see in 2021 for uranium?
2021 for uranium, bit of a question mark. We look at 2020, up and down year, and we're looking for a direction here where it'll go in 2021. Maybe I step back a little bit, Andrew. We're really bullish on where the market's going to go in the midterm, and that's underpinned by the fundamentals in the space, right? And everyone will say that about commodities. Oh, the fundamentals look good. The fundamentals look good. But here they really are bright. I mean, we've seen massive supply curtailments from some of the best mines in the world that have led to a significant deficit in the market. And so that really is driving a rebalancing of our market, and fundamentally it will be improving the story moving forward. We should see uranium prices pressured by these curtailments to a place that is more reasonable, and where these top tier mines can meet the needs of customers and make money, and that'll require prices that are higher than where we're at today, and we need to see prices move up. But what will happen, in 2021 is a tough question, actually, because the market is a bit fickle and it often responds to the latest news as a directional tick rather than the bigger news. And that's what I think's happened in 2020, and we're really now waiting for the next directional tick for the actual uranium market players to decide whether they have a call to action to start buying uranium that they obviously need, that the writing is on the wall for them, but they're not into that market quite yet, and they need to see, they need some directional tick to tell them whether they should be coming in or whether it is in fact safe to wait. So, it's actually a harder question than you think you've just asked in terms of handicapping what will happen in 2021. I guess what I'd say, maybe to wrap up on this point, unless you want to go further, which we can, is that the balance of risk and the balance of probability on where the price goes is definitely skewed to an increasing price because of those real fundamentals. We don't have a lot of action going on in the sector right now, and we've found a really good level of support close to $30 a pound, which is significantly up from where we've been over the last 3 years. And we've had moments above, but this is a really solid level of support here. And I think it really should act as a new floor, and we should be moving from here rather than being too concerned about losses from this level.
Yeah, I agree. I think we've seen higher numbers since 2016, and this is pretty much the characteristic style of the market as far as the timing it takes to move up, gradual, fairly boring. But at the same time, nonetheless, everything is lining up nicely. And I think to some degree, it's a blessing that we have more time. From an investor perspective, it's been quite a blessing. And a lot of people are probably impatient and don't agree. But to me, it remains to be a blessing because you can continue to selectively deploy capital. Talk about 2021 as far as the broader market and the economic conditions that are faced around the world with COVID likely to prevail in 2021. What's your thoughts on how that will affect Kazatomprom, Cameco potentially buying in the market and utilities, still asleep at the wheel?
Well, yeah, look, the nuclear energy industry is a different one when you consider the impact of the broader economic consequences of the pandemic. We don't have to look very far to see how that goes. We just look back to March, April, May, June of 2020. And so I think obviously there's a prospect of similar things happening in 2021. But what we know is that nuclear energy answered the call when the market and the economy and businesses were shaken by what to do with the pandemic. Nuclear power plants have such rigorous safety and operating protocols that they responded without any issues to the pandemic and kept the lights on. And they kept the hospitals running. And for us, and for the Kazatomprom and the Camecos, that means that demand was largely unaffected, whereas we certainly saw other commodities and other industries have significant demand reactions to the fact that people were shuttered into their homes and factories were closed. So I think I'm quite optimistic in terms of nuclear energy and its ability to continue and generally through 2021 without disruption, regardless of what happens with the pandemic. And I think that means that we'll see the demand scenario in our sector persist. There are implications of the pandemic that do affect the utilities, though. And one of those, I saw an infographic just the other day talking about the payments that people are or aren't making in the pandemic, the average Joe. And, of course, I could sympathize with that situation. People have lost work. They're trying to figure out which bills do I pay. And one of the bills that they're not paying is their utility bill. Now, it's not the first one that people don't pay, but it is one. And that definitely has a consequence to the utilities. And so if we go to that next part of that question of, and what will the utilities do, and how long will their behavior of non-buying persist, even though they absolutely need to? And that's something we have to consider, is that it could persist a little bit longer than even they might want it to, just based on the financial burden that their own companies, the utility companies, are facing by having some non-payment from their ratepayers. And so that's not the best development. But at the end of the day, as those inventories get drawn down by the utilities, because if they're not buying, and they're running their plants, they're consuming, and they're drawing something down, then that's their inventories. They've already been drawing those inventories down because of all of this uncertainty we've had in our market over the last several years, from the Section 232 petition to the Nuclear Fuel Working Group, particularly these guys in the United States. They don't really have, this massive amount of inventory. And they were already in a lighter than normal place. So if they do look to lean on those inventories to avoid sort of the capital outlay of topping up their inventories, then because of pressure from those ratepayers, it's really going to put them in a spot where they have no choice. Like, they're already vectored that way, but if they do that for yet another year, then we're really poised for the utilities to all come in, or many of them to come in at the same time, with more indiscriminate needs. They're certainly able to be selective right now. And I think that's why you're seeing little activity in the market, is that they're not being pushed to buy material, they're being selective. And there's pretty big bid-ask spread on a lot of big deals, so not a lot's happening. And they're able to say, okay, well, I guess I don't really like that price, so we're not going to transact. But the pandemic has this possibility of causing them to push that activity out, and maybe to your point, gives us a little bit more time to position into the sector. But it really does set them up for a difficult spot, to be in a difficult spot when they actually cross those thresholds on inventories and have to come back into the market and buy no matter what. And that could be very exciting for the uranium price. It'd be a challenge for companies to respond, right? Like Cameco and Kazatomprom, they do have shuttered production, but even Kazatomprom can't respond overnight. It takes some time to develop their well fields. And turning back on McArthur River also does not happen overnight. So there certainly is a window there where you could have quite a pinch. And then if the long-term demand starts coming in behind those utilities, because they're finally restocking for the next cycle. Well, then we just have a shortage of projects, and that's really the whole upside that people need to see in our sector, is that the project pipeline's broken because the price has been so low for so long, and it just takes the utilities to get into the sector in a meaningful way for that to be exposed.
Yeah, the longer it goes on, the better it goes. And the point about existing restart capacity, even if you bring on all those restarts, all of them, which obviously a lot of them need 45, 50, 55, really to see everything existing capacity brought back online, unless you're extremely ambitious to lose more money, you still have a problem if anybody wants to restock. So if you want to buy some extra stock at the grocery store, those shelves will still be empty because there's nothing coming in. So, well, let's move over for a moment. Let's talk just briefly. This show's about Denison, but let's talk just briefly about Uranium Participation Corp. General update there. Talk about the monetization strategy there to sustain itself and to take advantage of the various market stages going forward. Do you see that Uranium Participation Corp ultimately ends up lending material? And also, do you see that part of the monetization strategy in the future is some type of sale of uranium to utilities?
Well, UPC has been a fun company for the last few years, because whatever's happened in the market, we've been able to exploit for the benefit of the UPC shareholder, and that is a fun thing to do. To know that even when the price is down, you're able to actually accrete value for the shareholder. UPC doesn't really exist to have an exit, if I put it bluntly. UPC really exists for the investor to have exposure. So, there's no preconceived plan of UPC liquidating any of its holdings at any time to anyone. The plan is for it to exist so that the private investor can participate directly in the moves in the price of the commodity, rather than investing in a Denison, as an example, where the investor takes on risk and the reward associated with the mining business. UPC is really just trying to give that pure commodity exposure, and so I don't think anyone should. And there's been totally unreasonable discussion about UPC and what it's doing and when it will do it. And at the end of the day, the UPC's pounds are in the vault. The company exists to have pounds in the vault so that the investor can buy them and get exposure. Nobody should have UPC in any model for the uranium sector as inventory that will supply the market, because that's not why it exists. We are happy to have the material in the vault for good. Otherwise, we don't have a product to manage. Otherwise, we don't have a way for the investor to get that exposure. Now, our strategy over the last 2 years or 3 years has been focused on one thing, and that's also been a point of confusion amongst some in the industry that we've really focused on clearing up. Is UPC is not a trader. UPC is not a speculator. UPC exists to do one thing, and that is provide that exposure to the investor. To do it properly and to do the best job we can, we focus on one measure, which is the pounds U3O8 equivalent per share. Every share, the whole company is valued on our uranium holdings. If we can get more pounds U3O8 equivalent in each share, then we've added value for that shareholder. And so our transactions are all about that. If we trade at a big discount, then it is accretive. We will add pounds per share. If we sell the uranium, a small amount, at the market price, and then we buy back our shares at a discount to the market price. I mean, the math is not hard. That means we will have taken away fewer pounds than we did shares in relative terms, and we will add pounds per share. When we trade at a premium, we do the opposite thing, and we've done that for years, which is raise money at a premium to the actual uranium price, and then we buy uranium at the actual uranium price. So again, we've added fewer shares relative to the number of pounds we've added, and that adds pounds per share. So it's so funny because the company is so simple, and yet there's so much discussion about UPC being a seller in the market. We've sold almost none of our actual inventories over the life of this company, but we have added millions of dollars of accretion by doing exactly what I described and clipping that arbitrage that exists sometimes in our stock.
Good points. And one of the things I think, with UPC and with Yellowcake is typically in a bear market or, stagnant market conditions like we've experienced, where we're not necessarily in a bear market anymore, but we haven't realized the fun of a bull market yet, where there's a discount that occurs. And what do you think that discount is discounting? I like to think, and it's been our opinion, that the forward cost of G&A for these types of funds is where the discount lies in a bear market. And then, of course, that changes and we go to a premium when we get into better market stages. What's your thoughts on that?
Well, I think that's probably part of it. I can look at UPC and see that, through those accretive transactions, over the last decade, just as an example, we should have seen our pounds per share decline for exactly that grind associated with G&A, right? That would be normal. We've actually seen our pounds per share stay flat or positive because we've been able to offset that grind of G&A by doing these accretive transactions. Now, I think that's part of the reason why UPC trades typically better than Yellowcake when you look at premium discount to NAV. I think UPC also trades better on premium discount to NAV when we look at Yellowcake on liquidity. So part of it is you're right to say that there's a sensible thought process there around the cost of ownership in a bear market, and frankly in any market. But I think you also see other factors affect the NAV premium discount, probably more so. And like if we look at March 2020, when obviously we had this pandemic crisis in the market, UPC got to a 30% discount. I don't think that was really sentiment on the uranium price. I think that was liquidity selling in the market generally. And so we can be vulnerable to those types of things. Now, we didn't stay at 30%, and then we bought back stock as we made those accretive transactions, selling a little bit of uranium. We got that discount back into the single-digit range. It's bounced around a little bit. I do think it is a measure sometimes of sentiment, which you do have to be cautious about. I mean, someone is buying UPC, for example, today at a 10% discount to the market, if that's where we're at, just for illustration, right? Does that mean that the uranium price will decline by 10%? Not necessarily, right? There are literal in-market factors affecting the people who hold UPC, the way they're trading UPC, that are not perfectly representative of the uranium market. Right? It is not. The uranium market is not that big. UPC is not that big a company. There are other factors like that liquidity selling that can play into it. Broader market sentiment, like we talked about earlier, just general market sentiment is another thing that can affect it, similar to that liquidity selling. People have seen UPC have big gains. It is still an equity, where we have big gains, we sometimes see profit taking. So there are a lot of things that actually do factor into the way the company trades. Certainly, if we're at a place where we're trading at a 20% premium, I mean, someone must be very bullish the price of uranium to be paying 20% above the implied market value when they're buying UPC. And that's usually a sign for us that we should be raising money and buying uranium. And that's usually what we do. So it's a little more complicated, I'd say, Andrew, but it depends on which set of glasses and lenses you're looking through. There's usually some information value in the way UPC trades, but it really ought to be used with a great deal of caution because of all those dimensions that can affect the trade.
Yeah, and these are all good points that you bring up about, the sentiment and, of course, the liquidity issues that we all saw across the sector in March. Certainly, it makes sense to raise when you have a good premium and you can add assets, cake in a can, into a storage facility. Well, let's move on. Let's get to Denison. Recent capital raise, largely unexpected by the market, it appears, from looking at the price action. Shares ran up around the upper 50 cent range in September. Speaking from the New York Stock Exchange AMEX listing, the raise was about 37 cents for about 19 million US. Who was the demand coming from? Why was it done now, Dave? And how far would this carry the company considering the stagnant market conditions probably through 2021?
Well, Andrew, good questions, and I'm glad the timing of our call here, our interview is really good to be able to have a platform to cover some of this. You know, I think we need to take a slight step back to talk about the equity raise in the right context, and so I'm going to try to do that and make sure I come back to the right question, okay? But because I definitely don't want to skirt any of those questions, but to understand why we would raise the money. And perhaps to demyth the fact that we wouldn't have needed the money, we do have to go back to what we're doing with the company and where we're at, and it takes us back, to 2018 when the pre-feasibility study for Wheeler River came out, and we had the powerful combination of in situ recovery, mining, and the high-grade Phoenix deposit. Phoenix's highest grade undeveloped uranium deposit in the world. That with that cost profile of operating expenses just over $3 US, and all in, fully loaded all in costs, initial capital, sustaining capital, operating, closure, all that stuff at $8.90 a pound US. We made a decision at the end of 2018 to move this project forward. It was a no-brainer. I mean, we can figure out the price at the time. It doesn't matter. With an all-in at $8.90, this is potentially the best project in the world, built or not built. And we're bullish on the uranium market, but we didn't need to rely on an increase in the uranium price to justify the capital to develop this project. And so that decision was made in 2018. There's been no change to that decision. In 2019, we got going hard on this project in the field, and we actually carried out, this is within months of that PFS, we carried out a live in-ground ISR test, with not using reagents, but pumping water through actual wells drilled into the ore body. We were at that for months, proving up that we could move solution through the Phoenix ore body. And all of that work culminated in a news release that came out, unfortunately, during the pandemic, earlier in 2020 here, that declared the third-party consulting firm Petrotech, hydrogeologic experts, had taken all of the data that we collected from our actual field test, right, from actual wells, actual pressure transducers in the ground, and they calibrated all of this actual data into a model that laid out how the water flows would work in Phoenix, and then they simulated an ISR mine in that hydrogeologic model, and they declared, not us, okay, they declared that we had achieved proof of concept for ISR mining at Phoenix. I mean, this was a massive, massive accomplishment for us. And so here we are, we're approved, we have high conviction around the project, we prove up the concept through our work in 2019, in early 2020, and we've got an environmental assessment that had already started in 2019 with an approved project description and a favorable scoping decision from the CNSC, our Canadian nuclear regulator, which will oversee this process, that we can follow generic environmental assessment guidelines. All of that is wind in our sail for development. And so our objective is to build the mine. And every year, the mine doesn't get built or falls off schedule. Our NPV for this project is being pushed out a year. And that NPV, I mean, Phoenix alone is a $900 million pre-tax NPV. I mean, let's do the math right now. 8% on that, our discount rate, you're talking about $75 million a year in lost NPV every year you push it out. And so for us, raising the money had to be done one way or another. And if you're interested in the long-term story of this company, then frankly, we all should be applauding the fact that the money's in the bank and the project stays on track, because what we save is a $75 million loss in terms of value to the shareholder by having the money in the bank. So now if I come to that question, you can see that for us, we need the funds to move the project forward. This work is not free, and it's absolutely necessary if we're going to drive value for the shareholder. I know that nobody likes the share price, and trust me, nobody ever likes the share price when you raise money. Never. I've never gotten a call that says, that's a great financing. You've got the exact right price. That never happens. But people need to look at not the fact that we raised the money, because it was always going to be needed. But they need to look at what we're going to do with the money and what it's going to mean for the underlying value of the company. And that I could talk about for hours and be happy to go through that. But I think when we look at the exact timing of it, if I try to get back to the question, and sorry for the journey, but we really want to get the environmental assessment back on track. The EA has been paused through the pandemic because we could not carry out the consultation work necessary through the communities in northern Saskatchewan, and to save money because the regulators aren't free. If we didn't make a formal decision to pause it, the regulators would keep charging us their costs. By making the formal decision to pause the EA, which we made in March, we've saved a lot of money. And we really do want to get back at it. We want to get back at it properly. We need money to do that. And we wanted to put the money in the bank so that we could put together and act on and deliver on some really fantastic plans for 2021 and beyond. And so that goes to the last part of your question. Where does this money take us? Well, look, today, so end of October 2020, we're sitting with $29 million Canadian in cash. And that gives us a lot of runway. It gives us a lot of runway to move this project forward on the EA and on the feasibility study. The expectation on our end is that we're not coming back to the market in a meaningful way anytime soon. We've got our mandate, which is unchanged from 2018, to deliver on this project. And now we've got the cash in the bank to do it.
Good points. The context surrounding MPV, the big picture, I think that shareholders sometimes lose sight of the larger picture here. We don't have any issue. We're content with what you guys are doing. And we understand that sometimes when the money comes and the share price is a little bit better than it was, obviously, if you look at March 2020, you say in April, I want to say you guys raised a small amount of money, but the share price at that time during COVID sell-off, I believe we got around, I think it went below 20 cents if my memory serves. And then we were up around 57 cents or 56 cents there in September.
And Andrew, that's part of it too, right? Sorry to cut in. I mean, people have got to remember, we didn't soak the shareholders by raising a bunch of money in April. We needed that money to carry on through the pandemic. We didn't know how the pandemic would go, but we took a real sensible small amount. And the idea was, you can try to pick the top, but there's a funny thing about the top, okay, is that there isn't depth at the top. That's why it's the top. So, if you realistically think about where you can actually tangibly raise big quantities to move your company forward, it's never at the top. The top is the top because there isn't a buyer anymore at that price, right? Well, I need a buyer to be able to issue the stock, and so. Well, and frankly, even when you do issue the top, I mean, everyone then is a loser on that financing, but there isn't depth at the top, and so actually the way you've laid it out, when you kind of think about where we've been, it makes sense in a way that we would have a significant up round from the April financing, but that we would be raising somewhere between the two, right? That's where you're going to see the depth and the support for the story is somewhere between those 2 points, and that's really where we came in at. And, this just for metrics. I mean, if you take, there was some very volatile trading on our stock the day that deal was launched, and just for everyone's benefit, I mean, this is a public offering on a shelf prospectus through Canadian securities rules with distribution in the U.S. That type of offering doesn't happen like an overnight private placement in some of, like you might see in some of the more junior mining companies, and we've done those before too. Some of those overnight private placements, they literally happen at 4 o'clock that day. You see where you've closed in the market, you call up a broker, and you see if you can do a deal. The deal we did didn't do that. It wasn't one of those. I mean, it took time, legal compliance, and time with the underwriters beforehand. And there was a lot of volatility on the day that the financing went live. But if you take that volatility out, and we can all speculate on whether that was impact of a blogger or some other factor. I mean, the sector didn't move, so it seemed like something was up on our stock. But if you take that volatility out, and you look at the pricing on our offering on the 5-day VWAP from the 5 days prior, the financing went without a warrant, no warrant, at a 9% discount to the 5-day VWAP before. It was well supported, significantly upsized, and I'll tell you, it had a diverse book of institutions and really good support from retail. So it was a really healthy offering, and that's the way we want to raise our money instead of raising it in April in a more distressed environment.
And Dave, talk about just the demographic that came in, if you can. Is there any names you can share with the demographic that came in, maybe new shareholders, anything on that front?
Well, look, I'd love to, but I can't. In a public offering, it truly is a public offering. So it would be like a broker telling someone that, hey, Mrs. Smith just sold her shares in IBM, right? So that is it's a fair question for you to ask, because it's common for people to provide some color around, the financing was anchored by this person or that person, and we've certainly done that before where we can. But in a public offering like this, it's basically illegal to name off any of the investors. What I can tell you is that it was a really diverse and distributed book with many, when I say many, like 20, institutional investors, all with good levels of buying power, hence the size of the offering, and a really nice retail uptick with significant cutbacks across the board to actually settle on the level that we closed versus the level of interest. So that's about as much as I can say, and it is. I'm glad actually that I get the opportunity to say that we can't comment on specific investors because of the type of offering, because I know there are some questions around, well, who are the, other people will tell, will say who the lead order is. Why aren't you doing that? Is it someone sinister? And no, it's not. We just are legally not permitted to share that because of the nature of the offering.
Okay, let's break it down a little bit. Was there any uranium specific focus groups that came in under this? And was there any general natural resource groups that came in under this?
I would say yes to both.
Okay. Just briefly, you talked about the small capital raise during the COVID sell-off. What was your thought process? Take us back to those days in March where everybody was getting slaughtered, and talk about your thought process there and the need to raise a little bit of money.
For sure, not a complicated one. It was very much a make sure that this company survives. People have to realize, Denison has a really solid asset base. We've got a great board of directors, and we have a long history. And everyone would never think about a company like Denison having survival situation. But every company was in that state one way or another in March. And we were in a position where we needed money for the year anyways. We probably pushed it out too far in terms of not raising the money, and part of that's because we didn't want to dilute shareholders at prices we didn't think were representative of where we'd want to be. But that's like playing the stock market. And at the end of the day, we didn't know how the pandemic would go, but we knew that we were running light on funds. And so we called up, I use that term sort of figuratively, but we leaned on some significant shareholders, and we were very grateful for their support. The Lundin family was a significant participant in that financing, and they were not, price sensitive per se. They were there for us when we needed them, and we were very gracious for that. And there were others. There were uranium-specific investors that everybody knows. that were also amazing supporters during that financing. And really, it was about finding the quantum of money that our strong supporters were comfortable investing in that market, but that also gave us a real nice security blanket that says, you know what, we can continue out for 12, 18 months in one form or another with this money in our bank account. And we wanted to see the other side of the pandemic. And like, well, nobody's through the pandemic, but we've certainly been able to adjust our vision to what it looks like to be in the pandemic, and the markets have continued, and in some areas are very positive, and that's all great. That's what we wanted to see. We wanted to see the other side of it, and put our plans together, figure out where we're going next, and then come back to the market for the money that's necessary to move the project. And that's exactly what we've done with the October financing.
We had one of our audience members write in, Dave, and I want to share this, and I quote here: "I normally trust the Lundins, but something is strange. About 7 months ago, they raised about $6 million to fund business activities planned for the remainder of 2020 and 2021. Now it's $19 million for an EIA they're already working on, more evaluation, more general working capex," end quote. As you know, the company now has 677 million shares outstanding, pre-definitive study and pre-development financing. What are your thoughts on limiting dilution through to sustaining cash flows?
Well, it's a focus constantly to limit dilution, but dilution is a reality of a developer. I mean, we have internal cash flows that help offset some of that from UPC and our closed mines business, but advancing a real project forward in a way that is buildable, like building a team, building the project, and actually advancing it with an actual conviction to construction is not a cheap date. And I don't want people to think that there's endless dilution ahead, but they do have to recognize that we have to fund this, and it's not going to be free. But what they also have to understand is that every dollar we put into de-risking this project results in an adjustment in people's implied discount to our NAV, and that adds value. So we're not diluting without doing something. We're diluting and we are adding value. And I can give very specific evidence of this process, because when we put out that proof of concept news release, again, lost in the pandemic, but not by all, because we have very good research coverage. And we had 2 different research analysts change their target price on the back of that proof of concept news release. The explanation being, this is a material development for this company, and this de-risks the project significantly. I'm adjusting my price to NAV target ratio or something similar in their model to reflect the fact that the company has increased the value of its assets. Okay? Amongst others, with very positive comments from all of that, we had 2 target price increases. I think we even had like an upgrade by one, like in terms of, from a hold to a buy, something like that. I'd have to go back and check. But that's what we're getting for the money that we're spending, right? This isn't G&A. It's not G&A holding costs that literally just erode your exposure to the company. Most of that we're funding through our cash flows. All of this money is going to de-risking and moving us closer to that NPV. In the same way, so Andrew, it's a similar thing. In the same way that time hurts the NPV, right? Every year that we push that NPV out, we lose $75 million. As long as every time we de-risk, we break that NPV more real. And that means that someone can pay, closer to full value for this project every time we de-risk. So there's tangible consequences when it comes to adding value from this money. And we'll focus on finding the best way to raise the money to minimize dilution. We do not prefer equity, but and we would love to bring in things like strategic investments or streams, royalties, things that, pre-sales of uranium, anything that links more to NAV than to a discounted NAV. But people have to understand that those things are not always good. They're not always economical, and they sometimes have really negative consequences associated with them that we're also trying to manage. So it is a question of when. Sometimes it's a question of when does the dilution happen? I mean, is a shareholder happy because there's no dilution today, but by the way, tomorrow when our share price goes up and a convertible debt or something like that gets exercised, then there's dilution. I mean, does that make people feel better? So it's one of those things. Like there's a natural balancing in all of these stories and in all of these equations where moving the project forward is not free. I mean, even if you're selling your product in advance, that's not free, right? That's a revenue you will not get later. You might consider that having a lower cost of capital because of the way it's calculated, in which case it could be a good move today. But it really is math, and we are good at math. I mean, I'm a CPA, and so I do a lot of math, and our team is really strong in that, and we're constantly focusing on, can we find other ways that have a lower cost of capital than the equity market? And for this situation, there were not lower cost of capital means to keep that project moving and save us that $75 million hit on the NPV. So anyways, I digress a little bit. It is about what do you get for the money, not the absolute impact of dilution, because it's not happening. We're not diluting in a vacuum. You know, we're taking the money and adding value one way or another.
Yeah. And, you know, there's a number of other companies. If people are wanting to find companies that are just burdened G&A, there's a number of those out there for selection, a few close by there. And certainly I agree. And the net present value analysis, if anybody looks at that and they look out the amount of time that we're talking about on some of these projects, how the NPV drops off over time is substantial. So I think what you guys are doing makes sense. Short term, it might hurt a little bit, but I think long term, as this project moves forward to project finance and how you guys structure those deals and how some of the strategics and the strong backers come in and get some of those deals set up, I think that's when we'll start to realize the good deal that's been set forth.
Maybe just one other thing. I mean, sorry to jump in again, but you know, we're in it for the long run, right? And that's what we're focused on. I know that there's pain in the short term. And you know how I know that? Because I own a lot of stock. Not only do I own stock, I got stock options. And, you know, if anyone has any doubt about our conviction in the long run, they don't have to look very far than to see that this is all public. I mean, this all gets filed, to see that I have stock options that expire in November. And they're well priced, and they were in the money before the financing. I did not exercise them, didn't clip them, thinking that we would do a financing and wanted to pocket that money before we did a discount offer. I didn't do that. And they're out of the money now. Now, why would I do that? I do that because I own a bunch of stock. I have a bunch of restricted share units. And the value that we're going to create from having the money in the bank and moving the project forward far outweighs the value that I'd have gotten clipping that option, right? So, I mean, I even bought more stock in the offering. So we're in it for the long run, and that's the focus. But we totally sympathize with the what I'll call short-term pain that some people have definitely felt.
Going forward on some of these potential capital raises, issuance of shares, will you guys look at using the existing shareholder exemption under Canadian securities law to maybe also involve some smaller existing shareholders that are maybe more on the retail side?
Look, I mean, nothing's off the table. It is sometimes a question of magnitude, right? And you know, it's funny. I mean, if you do sort of smaller offerings, I certainly think there's an optics there of consistent, you know, perennial financing or regular financing, that sort of thing, which I think can be negative. But we're certainly not opposed, of course, to existing shareholders coming in. We generally have not been using that exemption. We've typically done, lately we've done 2 public offerings this year, and prior to that we would have often done private placements where people are coming in exempt on their accredited investor status. But you know, often that'll exclude sort of the retail shareholder. But these public offerings are wide open to any investor, including any retail investor. And I did get some feedback on that in the last offering where I did get a shareholder email, you know, suggesting, oh, we're just doing these deals with these institutions, and then those guys are just turning around and sticking it to the retail shareholder. And I sent that guy, we traded a few notes, and basically I sent him a note saying, well, look, actually, this is a public offering. You can participate. You just need to have a broker that's in the syndicate or in a buying group. But yeah, these offerings that we've done in 2020 that are considered public offerings, they're open to anyone. So that is different from us. We have typically been doing private placements that would use accredited investors only.
And I believe that particular exemption can be used concurrently with a larger placement, is my understanding. So it's something that would happen together, maybe under a shortfall scenario or something. But
I think we've seen the Lundin Group companies do that sort of thing before, where they've done an offering with a concurrent private placement for sure.
Yeah. Let's move to the ISR on Phoenix. Let's talk about that for a moment. At this stage, with what you guys have done, and we'll get to the environmental assessment here in a moment, but talk about just the method here and the technical risk for using ISR. How confident are you that the risks have been mitigated, and how certain are you that this project moves ahead as currently planned?
Well, we've never been more confident. I'll say that pretty bluntly. Our technical team, we bolstered it on the backside of the pre-feasibility by bringing in literally, a guy I will describe as a Saskatchewan mining legend, Dave Bronkhorst. Spent many years at Cameco, was involved in the construction operation of McArthur River, and really smart, innovative, technical guy. Dave was in retirement from Cameco. He'd been very successful there, and we actually lured him out because he was already interested, frankly, because he was looking at what we were doing with the ISR, and he was convinced, before we even convinced him, that it was going to be a game changer for the Athabasca Basin. And since then, we've done that massive field program in 2019, where we drilled a whole series of test wells and commercial scale wells into the ore body. We actually operated pumps, moving solution through the ore body. This is like an actual field test, right? This is not a lab test. We've mapped out parts of the hydrogeology for that deposit. We have an understanding of how things are flowing. And then really it culminated with that report by Petrotech that we talked about earlier, where they concluded we had achieved proof of concept. I mean, our confidence level has never been higher. This is a third party that has no skin in the game to say that we've achieved proof of concept. I mean, they could have just as easily said that this will not work. Instead, they've said this will work. That has us very excited. Now, there's other work that's gone on, but all of it's been designed around conquering the primary technical risks identified from the pre-feasibility study. The first of which was around the permeability of the host rock and its varied nature. That's really a question of, can you move solution through the actual host rock? So all of this work that I'm talking about from 2019 and that proof of concept report, it proves we can. So number one technical risk, well in hand, right? Second technical risk was really around like the leachability of the rock. Our test work that we'd done through the PFS was more conventional in nature. So bottle roll tests, column tests to figure out like the leachability. Well, like those aren't really they're representative of the rock, but they, just for everyone's background, I mean, all those tests involve taking core samples and breaking them up. And it's really about like figuring out how much you can leach from the rock if you put it through a mill more than anything. And of course, we do not have a mill with the ISR plan, right? We're leaching in the ground and then we're precipitating the uranium out of that solution on the surface. But so there's a risk there that that test work wouldn't be representative of how it would leach in its in situ state. So we carried out a specialized test at the Saskatchewan Research Council in Saskatoon with intact core. And we got a photo of this apparatus in our slide deck. It has an SRC logo. It's a big blue piece of equipment. But what it does is it takes that intact piece of core, packs it in a sleeve, and has an outer sleeve around this inner sleeve that pressurizes the sleeve on the core so that the sleeve is tight to it. And then it introduces the leach solution to one end of the core. Well, of course, with that pressurized sleeve tight to the core, the leach solution has nowhere to go but into the core itself. It cannot go around it and leach the surface. It has to go through the core. And we put out a news release at the beginning of 2020 that provided the results from one of these samples. And not only did the solution move through the core, which, our other work that we've done on permeability and with permeameter testing suggested it would. So not only we verify that we actually could leach physically through the space in the core, right? A lot of people will think this uranium is super dense. It's really heavy and feels like a high-grade uranium core, feels like a bar of steel. Well, it does. But when you use that microscope to look at it, it's actually quite globby in there, and there's room for the solution to move through it. And so not only did we move the solution through it, we recovered like 30 grams a liter over a 20-day average from that sample. Our PFS only relies on us recovering 10 grams per liter. So if we can replicate that, that means that, for the same equipment, we could produce 200% more pounds, or we can shrink the size of our equipment and produce the same 6 million pounds that we were modeling, or of course somewhere in between, right? But that really took a lot of risk out of that second risk around, took a lot off that second risk of our ability to leach in the in situ state. So in 2019 and early 2020, we've really conquered some of the biggest technical risks, the highest priority risks already. And now we're really advancing into refinement and sort of final de-risking, just, in a stepwise approach. Like, eventually we have to get to feasibility study level, and we're not there yet on the field tests, but we aren't going to just jump ahead to a big pilot plant or anything if we weren't achieving all of these milestones. And so our confidence around getting there is actually quite high now, because we've seen fantastic results in key areas that we have tested, and we've tested the highest risk items already.
Very well. I assume that this will, from what I've seen about it, I don't profess to be a technically proficient in all of these different methodologies, but certainly it looks like this will move forward as intended. And it sounds like you guys are confident in that. With the interruptions with COVID, which I'd hope at this point that policies and procedures are in place by now to stop the lost time, what's your current thoughts regarding the timeline for Phoenix in regards to completion of an EIA, getting to the DFS, the permitting, finance, and breaking ground? What's your thoughts on timeline and the sequence milestones from here?
Well, Andrew, we definitely have been working on that throughout 2020. Again, I totally sympathize with the interest in asking that question. But we're also not exactly in a position where we can disclose it. Now, it doesn't mean that we won't be coming up, but some of these things, of course, require board approval, joint venture approval, because we have made a formal decision to suspend the EA. The formal part of the EA requires a formal decision to resume the formal part of the EA. The team has not been inactive. The team's actually been very active. So you're right. We've been back in the field. We have developed the policies and protocols to operate in a COVID environment. The team has not been sitting on its hands. We did complete an ISR field program in 2020. We just put out a news release in regards to that. And all of that work was designed to be able to allow us to come back aggressively when the EA resumes, so that we haven't lost time, or that we've minimized the impact of the pandemic on the schedule. So this is what I would call blocking and tackling, right? We were blocking and tackling this summer, not as glamorous, but specifically designed programs to make sure that things that could affect the timeline that we can do, we've done, so that we can come back with a timeline that is maybe less impacted less than some might expect. Now, that said, timeline is complex, Okay, we have 1,000-line schedule. I don't know, maybe it's 2,000 lines. So it's a very detailed schedule of all these steps and things that need to happen between now and construction. And it is dynamic. So yes, while the environmental assessment is a critical item on that path, there are other things that our team has been working on that will have an impact in all likelihood on the schedule, but maybe not on the environmental assessment side of the schedule. And so we are really looking forward to being in a place where we can disclose that information to the market, but it is a process, and the market does need to let us get through that process properly to be able to provide good quality disclosure that guides the market correctly in terms of the new schedule for the project. What I can do is reassure people we're certainly working on it. The project will not be stagnant, has not been stagnant. Work has continued with a focus on minimizing impact to schedule. But we also are not in a spot presently where we can guide more specifically, but we certainly will be in a spot where we can guide more specifically at some point in the not too distant future.
And on the schedule, if you guys are able to advance some other critical path items and also maybe potentially cut slack where you guys can in that schedule, do you see getting potentially back on track, or do you think that that's outside of your control with regards to potential COVID problems going forward? And then lastly, put this in the context of your competing competitor development companies in Canada. Do you still believe that Denison is absolutely first to market with regards to large, high-grade development projects in Canada?
Yeah, look, I think the COVID impacts will be manageable. I think we'll be able to get back on track. I don't know that I can speak for the other projects and their status. I don't think there's been very much in the way of updating on some of the other projects. In a way, we get penalized for being very transparent about where we're at. So hard for me to handicap that second question in terms of where we'll be. I know that it is our focus, absolutely, to bring the project forward as aggressively as possible because it makes sense to do that, for our project. Our objective is to be the next new large-scale uranium producer in Canada, and we believe that is still something that is going to happen, and we're diverting our effort and our resources to do it. So I think when people are able to see the news that we have, and when it does materialize in a way that is rational, and see our new plans, our updated plans, and see what we've been up to, I think people will be more comfortable with all of that. And we completely sympathize with the uncertainty that's been created by a temporary suspension of the EA. But there's certain things that must be disclosed because they're real, and our formal EA is suspended. So we were transparent about that, and we've been transparent about what we've been doing, and we'll be equally transparent when the EA is resumed and when our new plans or updated plans are available. And where we can disclose them. And I think people will see that the story around Denison that everyone's very excited about has not changed. In fact, I'm optimistic that people will see the story as even better when they actually are able to share in some of the developments that we've been working on this summer.
Yeah, I would say that Denison certainly is ahead of your competitor development companies, comparable peers that have, similar size projects, similar production profiles. Talk about the major permitting needs here, Dave, just briefly. What major permits do you see as key permits to obtain yet? When do you expect to have them, if you can give us maybe a year to round off? And I suspect all of these will occur prior to project finance offtake.
Okay, so there is, we often distill the permitting process just to the environmental assessment. It is call it the biggest piece of that, but there's permitting and there's licensing with the CNSC. So there are other pieces to it. But really the EA is that longest lead and perhaps the most involved process. So, without getting into schedule, because of course we'll guide that when we're able to do so. We were planning to submit the environmental impact statement, which is a document that gets approved as part of the EA process, towards the end of 2020. That was our previous guidance. So obviously with the temporary suspension of the EA, that will no longer be the case. I don't think it's unreasonable for people to use a bit of a linear approach to understanding that, well, we've been suspended for a period of time. So I suppose the EIS is not going to be completed this year, will be completed next year. Look, again, without putting dates on anything, because we'll do the best we can when we make a disclosure on that, I don't think that's an unreasonable thought process for someone to have. We are expecting that once the draft EIS is submitted, you could be a 1 to 2 year process of engagement with the regulators and impacted parties. And of course, we will endeavor to make that be as short as possible. And I do think we have a very good case on that because of the nature of our project and the minimal impacts associated with the ISR mining. And the fact that we don't have tailings coming out of our operation is an example of whole chapters of this EIS that aren't going to exist for us, and hours and days of discussions with regulators and community members that simply won't be applicable for us because we just don't have the same sort of waste that will come out of a conventional mining operation. So I'm optimistic around that. Our plan is really to bring the feasibility study and the EA together at the same time because they relate to each other. There is the consultation process. Think of what that word is. You're consulting. Well, if you're actually consulting, you're taking the input that you get from those interested parties and you're considering it, and then you're weaving it into your project designs. So we don't see the value in having a feasibility study before we've gone through that process. We have updates all the time behind the scenes that are live. They're not 43-101. That's why they're not published. But we will be iterating throughout this process with the view of having a feasibility study coming together at the end. Now, look, others might follow a different path, and I'm not trying to be critical of that. Everyone has a different program and a different approach for their project. This is just our approach, is to have that feasibility study come together with the environmental assessment. And at that point, you really should be in a position to project finance with the two things in hand, right? The approved EA, you may be licensed or close to licensed with the CNSC as well, and the feasibility study. Those are the ingredients you're going to need. Off-taking, I don't know. It's not our objective to off-take a significant amount because we've got very high operating margins, today's spot price. But it'll be a to be determined what the financing group that we put together will need in terms of comfort to finance the project. And it's possible that there will be some requirement for some level of customer commitment, and we'll deal with that as we get there. But yeah, all of that stuff is going to converge for this project as that EA gets concluded.
The offtake portion, for a project like this, if the costs are true, that the offtake can be minimal enough to sleep at night to get the finance package through, but leaving your order book, your capacity book, very open for later stage market, which obviously will result in substantial differences of what we expect now versus later.
For sure. And Andrew, there's also different types of offtakes, right? And different types of contract commitments. We are intending to keep the book highly levered to the uranium price and uncommitted. But, a long-term contract that has good market-related terms, but that shows a financing group that customers support the project could be a very good thing without giving up upside or too much upside to a utility. So those are things we would consider. I don't want people to think that we'd never sign a contract on this thing. It's really just about us having the choice to sign the contracts that work for us, whether they be in the nearer term or whether they be in the longer term. The key difference is we do not need a contract to crystallize a 12% IRR so that we can go get credit agency financing for the development of the mine, right? And have the whole mine basically become a bond, delivering into an offtake, the whole book contract and offtake. That won't be us. But it doesn't mean that there isn't a place for contracting and off-taking on the project.
Yeah, that's correct. And Dave, with the capex coming in on the PFS, at about 243 million US today. Any potential to reduce that from here, or do you see that as really firm through DFS?
Well, there's definitely potential for sure. For sure there is. All these numbers from a PFS will be scrutinized as we go through the feasibility study process. So I would be to be frank and fair to everyone, there will be ups and downs, right? But I do think there's actually potential on the capex to be reduced based on some of the work that we've been up to. And it's already the lowest capex large-scale project in the Athabasca Basin by $1 billion, right? So, but yeah, I think there is potential for that. One of the other things that I do want to point people to, and I'm sorry if it's another question coming up, Andrew, but we do have a PEA in progress for the J Zone deposit. And so we're not going to be updating Wheeler River anytime soon, right? Because we can't really do much of an update until we have a feasibility study. We can guide on the things that we've worked on where we can. But there will be a new study coming out for ISR at the J Zone deposit in the fourth quarter. And so that could be that's something that people should definitely pay attention to in terms of our latest thinking on the ISR mining in the Athabasca Basin.
Yeah, and I want to talk to you just about that. I want to switch gears on some other assets, including Waterbury project in a moment, but come back for just a moment with the ISR method. And I believe you guys are at the point of probably no return and that there's no reason to enact a plan B. But if ISR does not work, is plan B to revert to conventional underground? And also with that question, do you see that the progress made in your guys' level of certainty that plan B is not required?
Yeah, look, I'd say Plan B is not required. We have high confidence in where the ISR is going at this stage, but if and we're quite committed to it. We're advancing the ISR mine through the environmental assessment, right? We are deploying our capital to test the ISR mine. So our conviction is very high on the ISR. We're spending time, not a lot of money, but spending time evaluating ISR at J Zone. We have a high level of conviction on the ISR. All that said, it is the mining business, right? So there is an implicit plan B because the pounds in the ground are not going to disappear. They will not go poof and not be there if for whatever reason the ISR is not successful. And you don't have to look very far on our side to see what a plan B could look like. And really that's 2016 where we had a PEA on the Wheeler River project, and we actually had Griffin being mined first as an underground mine, and then Phoenix being accessed underground for jet boring, similar to Cigar Lake. Now that's clearly an inferior plan when you compare it to what we've got now with the ISR, low capex upfront funding being used to fund Phoenix, and then Phoenix funding Griffin as a second stage. I mean, it's a much better plan. But if you wanted to look for a plan B, you certainly would look to something like the PEA to see that it isn't an ISR or bust scenario for the company, but at the same time, our conviction on the ISR is very, very high, and we have a strong view that it's going to work and it's going to be the new and best way, and frankly, the only way that you're going to want to mine in the Athabasca Basin if you can.
With Denison being under the Lundin umbrella, and the company really being the primary uranium exposure for the Lundin Group, how confident are you at this point that Phoenix does get permitted, it gets financed easily, obviously, based on the pricing, built and in operation by 2025? Because if your total costs are true, Dave, then the market price right now is not an object of concern. What's your thoughts?
Well, look, nothing is easy. So I don't think I would ever use the word easy to describe the process, but our conviction is high. Having the Lundins in your corner accounts for a lot. And think about the conviction around the mining method that we just talked about. Well, that conviction's been vetted through our board of directors and technical committee. Technical committee consists of Ron Hochstein, CEO of Lundin Gold, former CEO of Denison, Jack Lundin, son of Lucas Lundin, CEO of Bluestone Resources, just helped Ron Hochstein build their gold mine in Ecuador, is now building gold mine in Guatemala. and Bob Dengler, also mining legend from Dynatech, founder of Dynatech, that, these are mine engineers that have vetted all of the work that we've done through our technical committee. And they're sponsors from the Lundin Group, right? And they're adding value to us by putting us through the ringer on all this stuff and saying, guys, you have good plans and we fully support you moving forward with this. It's that kind of sponsorship that is going to be critical when we move this forward to the next stage and we look for that project financing and we turn to the banks and they say, oh, well, the Lundin Group supports this story. The Lundin Group and the Lundins are behind this and they believe that it's going to work. Look at their track record, right? So look, our conviction is high on the technical side, and we believe we have a lot of great ingredients in place for it to be commercial, for our conviction to be high on the commercial side, that we will be able to finance this project. It will not be easy. It will be like any mine project. I don't think any CEO from any mining company would ever say that their project financing was easy, but we believe that it's all looking very good in terms of being able to pull it off and be in construction and producing, and I'll say in the mid 2020s.
And I mean easy, I guess, in the context of the Lundin Group. When you look at a project like Jose Maria, multi-billion-dollar project, I guess that's the context. Reasonably easy.
Well, for sure, 300 million Canadian is a lot easier to raise than 1.3 billion or whatever it might be. I will give you easy in that context. Yes, Andrew.
Certainly. Let's move on to some other assets here. So the Griffin optionality. Do you see the production profile of Phoenix mid-2020s and through cash flows will in part finance the expansion towards Griffin capex if the market conditions warrant? Do you guys see that really Phoenix will be a pretty substantial financier of the expansion into Griffin?
So the PFS contemplates that strategy with the stage development of Griffin. And in the PFS, with all the assumptions we have in that base case, which has Phoenix selling pounds starting at just over $29 in its first year of production. Okay, so that's like at today's market price. Phoenix does fund Griffin development in its entirety. So the intent is that there wouldn't be new capital necessary. Of course, we will do the math to look at the use of capital and the cost of capital, because there is an internal cost to capital. Perhaps it would make sense to leverage Griffin with that cash flow from Phoenix, providing some support for that. But operationally and in the PFS model, it shows that Griffin can be fully funded from Phoenix the way we've structured it. So it should be, and I think people should be modeling that there will be one capital injection to this company to build Phoenix, and that should be it.
That sounds good, and that's good to clarify. Let's move over to Waterbury for a moment. So the decision to start a PEA for the J zone using the ISR method, what's the thought process behind this in parallel to the Phoenix work you're doing? And is there a thought to show and prove up a smaller scale ISR development there?
Yeah, a couple of layers to Waterbury. We certainly like the idea when we put the concept study together of testing internally how ISR can work in a smaller deposit, and what's the threshold that we would need to make this mining method work in the Athabasca Basin. Phoenix, we're blessed with 19% average grade, and almost 60 million pounds in the high grade core at 43%. It's not all the deposits in the basin are like that, right? It's the only one like that that's been undeveloped. So we did want to see how does this work, and I think it's important that people understand we haven't spent a lot of money on this because we have a team, right? Our company has made a choice to staff up internally with permanent staff because we're building a mine, right? We're not using consultants extensively. The incremental cost of doing this concept study on J-Zone was low. And that's because we already have built up this knowledge internally. And our team, frankly, is the expert. You really can't hire an outside consultant to offer what our team has built in terms of knowledge on ISR in the Athabasca Basin. We do need outside consultants to sign off on public reports because of the securities rules around 43-101. But frankly, whoever we hire, no offense to whoever we hire, they're all fantastic people, but whoever we hire will not have the depth of knowledge that our team internally has. And so pretty low cost effort, but it was really about trying to see, well, how good can this approach be? And then it became a question of, in my mind, of return on investment. I said, well, how much is it going to cost us to do this PEA and to scope out this project? It's not very much. I think we've got something like $500,000 in the budget or something like that for Waterbury for 2020. Well, what might we get out of this? Well, and of course, I'm not going to steal the thunder of the result, but you can tell that we expect it to be positive because we declared the concept study a success and moved to a PEA. And then you kind of look at, well, what is the market valuing J-Zone at for Denison today? And look, you can sift through all the research reports, and basically for anything other than Wheeler, the market gives us in situ value per pound on our resources. So, okay, well, we got 12 million pounds at J-Zone, 2%. We have 67% of that. So we can do that math. Let's call it 8 million pounds. So what measure are we getting from the market? And we're getting somewhere between $1, $2 a pound, depending on whose research report you go to. So, all right, let's say it's $1 for easy math. We're getting $8 million of value. Of course, we're not trading at NAV. We're trading somewhere like 0.4, maybe even lower, to NAV. So the market's valuing J-Zone basically at like $3 million, 1% of our market cap. I can tell you that we're not doing a PEA to prove up 1% of our market cap. And for the cost, I think it's going to be one of the best investments we've made. Just spending a little bit of money to take our knowledge and show that ISR on a 12 million pound deposit can be good, and putting an NPV on it. But people are going to have to reevaluate the value of our portfolio when we do that. And that's really what we're trying to do with J-Zone. We are trying to build a company that has more to it than Phoenix. We want to become the next Uranium One of this cycle. But we're not diverting our resources away from Phoenix. Phoenix is the focus. But everything we prove up at Phoenix, imagine if every dollar we spend proving up at Phoenix has a benefit to J-Zone or the next deposit or the next deposit. Think of the value that we're going to create with that money we deploy to Phoenix, right? Phoenix warrants all of that investment on its own, all of it. But think of the extra value that we're bringing. This is how we turn the company from being a success story into a massive success story in the long run with a rising uranium price.
Well, a compelling proposition you've got set up there, and I'm looking forward to seeing what those results come out and how that plays into the overall strategy. Let's move over for a moment. I want to talk about McLean Lake, the nearby conventional deposits there. Given this is a bit of a low-hanging fruit, Dave, when market conditions are there, when would you go after some of these pounds to put through McLean Lake Mill?
Well, so McLean Lake's a joint venture, and of course that complicates life. We're 22.5%, and we do have a very strong partner in Orano, or formerly Areva, at McLean. They own 70%. So some of that direction will certainly will have to be taken from Orano. What I will say about McLean is proximity is good. There's not a lot of pounds left. The richer deposits obviously been mined previously. So you're certainly looking at something that is marginal generally, that can be, and your point is totally on, right? Like can be useful in the right market, in potentially shorter timelines. What the McLean joint venture has been funding over the last few years is some work on a different mining method that could potentially improve the economics of accessing some of those deposits. Now, I am cautious around these McLean deposits. They are what's left from the last mining cycle, so they're not rich. We shouldn't see them as things that are going to be developed anytime soon. And right now, there is no real plan to develop them economically in this market. So they are there though, and there is value in the right market for those pounds for sure. So they're a real leverage, high leverage play. It'd be very comparable in a way to some of the African outfits that have much higher cost profiles.
Let's stay on McClean Lake for a moment. I want to talk just about the monetization deal that happened that you did in 2017. Can you just speak to what the status of this arrangement is today? What are the obligations remaining under the deal, Dave? And what is the plan to realize future value out of this asset?
Right. So let's do a recap here. So that transaction in 2017 was with Anglo Pacific, and what we did is we took the Cigar Lake toll milling contract and we monetized our share of future revenues from tolling of Cigar Lake ore. So it's only related to Cigar Lake. Any other material that comes to that mill from anywhere outside of McClean Lake could be subject to a toll milling agreement, and we have preserved our ownership of any of that, any stream coming from that. So that's critical for people to understand here, that we never sold our interest in the mill or our right to any other futures toll milling. We did monetize or factor or de-risk, if whatever term you want to use, our toll milling receipts that would be coming from the Cigar Lake contract. So for example, 2020, that is looking like a pretty prudent transaction to have done in 2017 because Cigar Lake shut down for several months and that toll milling stream was interrupted. And so that would have, if we hadn't monetized that stream, that would have had a direct impact on our financial results. We would have been short that cash that we probably would have been relying on. And in reality, this year it's had no impact on us. We already brought that cash in, and we were, not affected by it, and we won't be affected by any disruption at Cigar Lake or McClean when it comes to that arrangement with APG. So it's basically been a non-event for us, and it's really quite a simple transaction for us to manage now, because we receive toll milling from Cigar Lake and we pass it to APG. If we don't receive it, there's nothing to pass to APG. So, that's that transaction. In terms of what happens next at the mill, I mean, it's got 6 million pounds a year in excess licensed capacity. That's an asset. It's a strategic asset. It's got a tailings facility that's licensed. And by the way the mill exists, it's operating and it's self-licensed. So how do you realize value for that? Well, you got to put other pounds in there. And when you look at what's available, there are some deposits nearby. McClean, we talked about, not the best, right? Midwest has great potential. J-Zone's nearby. Rough Rider's nearby. I don't really expect too much to happen with Rough Rider. Rio Tinto seems to be very cool on the uranium space and have not been doing work there. But how about our Griffin deposit, right? And Griffin is planned in the PFS to be a source of feed from McClean Lake. So there are projects that can fill that pipeline. I would say that Orano is a little bit light on their own projects to fill that pipeline. So I do think that we have a very, very sensible case in terms of bringing some Denison production to our own mill for processing.
How does the current agreement with the Cigar Lake material, that expires at some point? I think 2030. I believe
it basically covers the life of, without getting into the details or anything confidential. I mean, it basically covers the life of Cigar Lake Phase 1 and Phase 2, however long that is.
Okay. And what do you see as, going forward? Obviously, it probably makes sense as long as you guys are in the area, that it makes sense that you guys retain that ownership portion in the mill. But maybe you can remind the market, what do you see, Dave, that the fair market value of that share is at this point in the market? What do you have to say about that?
Well, I mean, you can certainly do some math on it, and there's different lenses you can use, and we are good at math. But I can tell you replacement cost on that mill, actual cost, historical cost, is probably approaching $1 billion Canadian. So, I mean, that's a measure you could consider. But really, I mean, to answer that question, you have to ask, well, what's the value of actually having a seat at the table to access the mill's capacity? And that's invaluable. If somebody drums up a plan that they're going to send production to McLean Lake that doesn't own part of McLean Lake, I mean, how do you even have that discussion? And where's the balance of power in that discussion? So, is the McLean Lake joint venture going to make somebody else's mining company a success by providing them access to a mill? Maybe, if they don't have any feed of their own. But if an owner's got feed, I mean, I think that's where the value is, right? Is that an owner can be talking to another owner, saying, "Look, I've got product. Let's work something out for a toll milling deal." That's like a tangible, a real thing that is hard to put a price tag on, because it's like whether something is realistic or not realistic, right, Andrew? Like that maybe both have, maybe there's a value on that mill, but one makes developing your mining project realistic. If you don't have that ownership interest, it makes developing your mining project without your own mill unrealistic. That's pretty binary. There's real value for that mill. Hard to price it per se, but man, you'd want to have it if you could.
Well, it certainly isn't reflected in the market cap of the company today. I can tell you maybe later in the market, I think that'll obviously change, but it is an interesting proposition. The share there and how you've got that structured, I think it is a very, very strategic asset. Let's move on. Let's shift over to long-term contracts here for a moment. Do you see that the long-term contract deals, Dave, do you see that you guys contain that expertise in-house to secure those deals, or do you see that you'll be looking to outside consultants for this component?
Yeah, Andrew, similar story to what we've done on the technical team, and I hope people are starting to get the message that our company's for real, because we've made investments in people, and people are what make businesses happen, right? Not consultants. And so we brought in VP Commercial Tim Gabrick in 2018. Tim had long history VP Marketing at Cameco, knows every utility in the market, and we could do that because we've got that UPC contract, and Tim acts as our Chief Commercial Officer for UPC, so made a lot of sense for us to do that. But yeah, I mean, Tim and myself, I mean, we are perfectly capable of accessing that contract market and have with Tim's experience, we have all the experience you could ever ask for in terms of somebody going out to the market to build relationships with customers and ultimately contract with customers. So that's not something that we would expect to require outside help with. There's certainly rely on and lean on some of the industry participants and some of the experts out there. But Tim has those connections and maintains that dialogue to be well connected in that market. I'm expecting that we're going to do all of this internally and probably build up a commercial team over time.
Well, as you know, you've got around 11 million Canadian with investments in sector names such as Sky Harbor and GoviEx. What are the plans with Denison involvement with these companies, and is the plan to ultimately monetize these investments in a mid-late stage bull?
Well, I think those investments, like anyone who has investments in those companies, are filled with optionality. Let's talk GoviEx, for example. We've changed our strategy from being a company with international assets to one with Canadian assets several years ago. But we did not want to sell out on our African assets at a very low point in the market. I can tell you that our investment in GoviEx has already increased from where it was when we funded that company by putting in our African assets. And that was our expectation, is that we were not going to cash those assets out for very little. We wanted to have to participate in an improving market and an advancing company in GoviEx. And we still have that view that we'd like to participate in an improving market and an advancing company in GoviEx. I mean, it gives us optionality. If GoviEx is very successful and the uranium market moves in a particular way, then having a foothold in GoviEx means lots of things. Does it mean it's a block that could be sold to a strategic? Does it mean GoviEx could be taken out by a strategic altogether and we get cashed out? Sure, it means all of that. But it could also mean that it's a foothold in that company if there ever is a time when the market moves to a place where there is a case for being a more global company and having exposure to different production. I'm not saying that that's our strategy in any way. I mean, we're laser focused on advancing Wheeler, but just as an example of the type of optionality that comes from that investment. Similarly, there's that option of if we're looking for capital to advance our own project, is it a source of capital that we can tap into to build a Wheeler? Absolutely, it could be. And so we're really maintaining that exposure. We are protecting it. We've tried very hard to not monetize that as a source of capital, as you can imagine, because we don't believe the value that should be recognized in that story has been recognized either. And there's a better time to look at what to do with that investment rather than today.
Dave, wrapping up here, what do you think investors in the market is really missing about Denison, the existing assets and the company potential here?
Well, Andrew, you know what it is? It's look, and the timing of our discussion is fantastic, because I think Denison's story was lost through the pandemic. And are we to blame? Sure, in part. I mean, we came out transparent with the temporary suspension of the EA. I think what's lost is that announcement didn't mean that we've done nothing all year. I can tell you we've been as active this year as any other year. What's happened is that work has been internal. And it wasn't the same as 2019, where we had field tests and we were leaking out news drip by drip by drip because people were following this ISR field test. People got, I guess maybe a little complacent or comfortable, with the fact that we would have a regular drip feed of news. We had that for almost 2 years straight. This year we haven't had that. Well, you know what? A lot of companies in the development space don't have that, and I can point to our competitor of ours, NextGen, fantastic company. I mean, they haven't had a news release all year except for announcing their financing, but they've traded well, and they've got a great asset. Well, guess what? So do we, and we've been working on it. And so I think the investors are missing that because the company came out and transparently said the EA has been suspended, doesn't mean that the company hasn't been active. And I really want people to understand that the news flow is slated to pick up for our company, particularly with us being well capitalized after this financing. And I can point to specific things coming up, like that J-Zone PEA, that people need to be paying attention to. And if Denison's fallen off your radar because you haven't been getting your monthly fix of technical news from us, we'll put it back on the radar, because the company is still moving forward. All of the story and everything that we had people interested in before is still intact, and it's going to become again front and center now that we've put the money in the bank. And once we get this EA back off the ground and make a formal decision on that. So definitely, I do think people are missing that. There seems to be a perception that our company is not active, and that's just not correct. And I want people to understand that Denison has not changed. We've been active. We just haven't been able to put the news out because sometimes things take time to get done. And people can expect a more robust news flow cycle from us in the coming months. And they should really be looking at the stock right now post-financing, because the prospect of any near-term dilution of any meaningful amount is low. And yet there is significant news flow ahead. So it's a really good opportunity for people to be positioning in this name ahead of the work that we have coming up.
Well, very well. And I was going to ask you, with current price levels, market cap around 210 million US, why investors should be considering Denison now at this stage for the company, and of course the current uranium market conditions. And I think you just told them why. And again, I would also point to the fact that if you'd like a discount to the most recent financing, you have that today. Dave, any final comments on that? And then how can folks reach out to the company if they have any further questions?
Look, Andrew, I mean, fantastic chat. You always cover amazing material, and I've really enjoyed the opportunity to reach out to the investor community on this platform. And yeah, I think people really do need to look at our name and remember what they were interested in before, and realize that that's not changed. In fact, now it's funded, and we do have news flow ahead that people should be looking forward to. And to follow all of that, definitely on our website, denisonmines.com, or on our Twitter or LinkedIn, Facebook feeds. We're pretty active there. But yeah, I mean, we're very accessible. Please reach out to us through our website, and we're always happy to connect with investors on small questions, big questions, whatever it is. I mean, investors are our owners, and we really respect that. And if somebody has a question about what our company is doing, we will confront it head on, just like some of the topics we've talked about today. And look, I really just want to thank people for being supportive of our story. There are many people that are very happy with what we're doing, and they do see the long-term plan ahead here. And those shareholders and frankly, all of our shareholders are fantastic for being so supportive of our company.
Yeah, well, let's leave it there, Dave. I do appreciate it. Thanks for taking the time, and keep progressing, Denison, and stay well out there.
Thanks again, Andrew. It's really a pleasure.